Good morning, my dear students. In this session, we are going to discuss about the auditing. What is auditing? Simply, auditing means verification of accounts. Let us see the definition given by Institute of Chartered Accountants of India. What is the definition given by them? They define auditing as the independent examination of financial information of any entity, whether profit-oriented or not, and irrespective of its size or legal form, when such examination is conducted with a view to expressing an opinion thereon. This is a definition given by ICAI. Let us analyze this definition. First, the independent examination of financial information of any entity. What is financial information? All the business transaction which involves money. That is, we are considering it as financial information. These informations are firstly recorded in journal, and then it is posted to the ledger, and then based on the ledger we are preparing the trial balance and then profit and loss account and balance sheet of any entity. There are different forms of entity. It may be sole proprietorship or partnership or joint stock company or trust or government company. This entity may be profit oriented or service oriented. We are not going to bother about its size or legal form. We are going to conduct the examination with a view to express an opinion thereon. This is the definition given by Institute of Chartered Accountants of India. What is the objectives of conducting an audit? The first primary objective is to express an expert opinion, and then second one is detection and prevention of errors and frauds. Third one is specific objective. Specific objective may be required by the client. It may be to make an inquiry about future prospects of the concern, or making the cost audit or financial audit in this way. And then let us see about the main objective. For attaining the main objective, the auditor has to verify that the accounts are prepared according to the framework of recognized accounting policies and practices and relevant statutory requirements, if any. What is the recognized accounting policies? We know it well. There is a basic rule of accounting. For personal account, we have to follow the rule of debit the receiver and credit the giver. For real account, we are going to follow the rule of debit what comes in, credit what goes out. For nominal account, we are following the rules of debit all expenses and losses and credit all incomes and gains. So we have to verify whether this rule is followed properly in the accounts, and then statutory requirements. Some companies has to prepare accounts as per the statutory requirements. For example, we are going to prepare bank accounts based on the schedules. That you know it well. And then the auditor has to check the facts presented in balance sheet and profit and loss account are true or untrue. Based on his check, he has to express his opinion about the true and fairness view of the final accounts. This is the first objective of conducting an audit. And then secondary objective, detection and prevention of errors. What is error? Errors are mistakes done in accounts without any intention to deceive others or innocently. The accountant may commit 4 types of errors. The 4 types of errors are clerical errors, errors of principle, compensating or offsetting errors, and errors of duplication. Let us discuss about these errors in detail. First one is clerical. The clerical error may occur in posting, totaling, and balancing. Further, we can divide that clerical errors into error of omission and error of commission. Error of omission, if we completely omitted to enter a transaction, then it is known as complete omission. For example, on cash sales is made by the business for rupees 25,000. We have to make the entry as cash account debtor to sales. If we completely omitted to make the transaction in the journal, then it is known as error of complete omission. What is error of partial omission? We make the entry in the journal, but we fail to post that amount into the ledger. And then error of commission. Error of commission means something has been done which should not have been done. That is, when a transaction has been recorded but has been wrongly entered in the books of original entry or posted in the ledger, error of commission is said to have been made. For example, a purchase made for rupees 1250 is entered in the purchase book as 1520. And then how to detect the error of commission? The auditor has to done the vouching carefully. Some of the errors such as wrong castings, calculations, postings, extensions and carry forwards will be detected by the non-agreement of the trial balance. If the mistake is done in the invoice for the sales of goods, the error will not be detected. And then error of principle. The error of principle occurs when the entry is made without following the fundamental rules of accounting. For example, wrong allocation of expenditure between capital and revenue. What is capital expenditure? If we made an expenditure and we are going to get benefit out of that expenditure for more than 1 year means it is capital expenditure. If you are making one expenditure but the benefit arising out of expenditure will ceases within a year, then it is known as a revenue expenditure. This capital expenditure will appear in the balance sheet and the revenue expenditure will appear in the debit side of the profit and loss account. If the accountant made mistake in classifying this expenditure, then it will not show the true and fair view of the accounts. And then outstanding assets and liabilities may be ignored in preparing the final accounts. And then valuation of assets, they have to follow the valuation of assets according to the rules of accounting. How the assets are valued? Except stock, all the assets are valued at cost price less depreciation. For valuing the stock, we have to follow the rule of the cost price or market price, whichever is lower is taken as the value of the stock, for stock only. For all the other assets, we have to value the assets at cost price less depreciation. If this principle is not followed properly by the accountant, then we can set it as error of principle. It will definitely affect the final accounts. And then how to detect the error of principle? Through routine checking, we will not be able to find out this error of principle. It can be detected only by searching inquiry and independent checking. What is searching inquiry? Searching inquiry means, for example, a purchase of bike. What type of expenditure is this? Normally we say it as capital expenditure, but for a client who is in the business of selling two-wheelers, it is a revenue expenditure. So we have to be very careful in classifying the expenditure. Through inquiry only, the auditor will be able to find out the error of principle. And the next error is compensating errors or offsetting errors. An error which is counterbalanced by other error or errors is known as compensating errors. For example, mistake made in totaling in debit side of the ledger account, and the same amount mistake is made in credit side of the ledger account will tally each other. In this case, this error will not affect the trial balance. This error is very difficult to detect. Then how to detect this error? The auditor has to completely check the totals, posting and casting. A thorough and exhaustive preparation on the part of the auditor will help to detect such errors. And then next is error of duplication. What is error of duplication? We have to make one entry. For example, we make the purchase of 25,000 for cash. What is the entry? Purchases accounted are to cash, 25,000 rupees. But instead of making one entry, we make two entries in the journal for the same amount. This error will not affect the trial balance. We will find out these errors only by thorough checking and comparing of vouchers with entries in the books of original entry will reveal such errors. And then location of errors in case of disagreement of trial balance. The trial balance doesn't tally. How to locate the errors? First, we have to compare the names of accounts in the ledger with the names of accounts in the trial balance. Next step is we have to total the list of debtors and creditors and compare it with the trial balance. If the books are maintained on the self-balancing system, see the total of different account agrees with the total of those accounts with the balance of accounts as recorded in the trial balance. Compare the items of the trial balance of current year with the items of trial balance of the previous year to see if any item has been omitted. For example, in last year trial balance debtors is 1 lakh. In current year trial balance debtors is 25,000. Then we have to verify whether we receive that 75,000 from the debtors or we are not offering credit. So we have to make the inquiry. So we have to compare last year's trial balance item with current year's trial balance item. Whatever be the difference in the trial balance, have it and see if there is any item of this value. This is done to avoid the putting of the debit balance on the credit side of the trial balance or vice versa. It is possible that the totals of some subsidiary books like cash book, purchases book, sales book might not have been transferred to the trial balance. Recheck the totals of these books. In spite of the above check, if errors are not located, it may be due to following reasons. An error, say rupees 1 or 10 or 100 etc. around sum may be due to wrong totaling. If the difference is in rupees and paise, it may be due to wrong posting or extracting a wrong balance. An error which is divisible by 9 may be due to misplacement of figures like 32 as 23, 52 as 25 and so on. And then let us see about the fraud. Fraud! What is fraud? Error is a mistake done without the intention to deceive others or innocently. But fraud is the intentional misrepresentation of financial information by one or more individuals among management or employees or third parties. What is the characteristics of fraud? It is an array of irregularity and illegal acts characterized by intentional deceiving. It is committed for the benefit of the organization or employee or involves exploitation of an unfair advantage. How the fraud is committed? Acceptance of bribe and then using the inside company information against the interest of the company. Embezzlement of cash, misappropriation of goods, fraudulent manipulation of accounts. These are all the ways of committing fraud. Again I am repeating, acceptance of bribe, using inside information against the interest of the company, embezzlement of cash, misappropriation of goods, then fraudulent manipulation of accounts. Among these ways, chief ways of committing fraud is embezzlement of cash, misappropriation of goods and fraudulent manipulation of accounts. Let us discuss about these frauds in detail. Where the embezzlement of cash is possible? It is possible only in big business houses. It is not possible in small business houses. How the cash is misappropriated? Omitting to enter any cash which has been received. For example, a debtor comes and pay rupees 20,000 for his due. If you are not making entry means that will not come into the account. This cash may be misappropriated. And then second chance is entering less amount than what has been actually received. We are receiving 20,000 from the debtor, but we are making entry only for 10,000 rupees. Another 10,000 went into the pocket of the accountant. So in this way the cash may be embezzled. Another way of embezzlement of cash is making fictitious entries on the payment side of the cash book without incurring any expenditure. An expenditure is put on the payment side of the cash book. Another one is entering more amount than what